All right, guys, bang, bang. I've got Darius here. Darius, a great place to start is let's just talk about the economy. Some people think it's hot. Some people think it's cool. Some people think the Fed should cut interest rates. Some people think the Fed is doing a perfect job. But before we get to what we think they should do, let's dig into some data. Low worker turnover is this huge, talking point now. And you're saying that it's supportive of an economic expansion. Explain.
Yeah, absolutely. So thanks for having me as always. Great to be here. So this chart where we show JOLTS total job openings divided by total unemployed workers, that's that all important ratio that Jay Powell's been guiding us to as an indication of how much slack or tightness is exhibits in the labor market. In the second panel there, we show the private sector hires rate at 3.9% was unchanged month over month in the month of December. That's a below trend rate relative to the 2015 and 2019 trend. Third panel there, we show the private sector's quits rate, which declined to 2.4%, which is exactly the same number it trended at prior to the pandemic. And the reason that's important is because when we see lower turnover, as we've seen in recent quarters, it is supportive of the economic expansion because it takes the pressure off of wages in terms of the labor market.
Now, when we see this turnover, I also just saw that there was payroll growth
Yep.
is coming in under expectations.
Yep.
And so how much of this is mixed signals compared to no, some of these data points are actually more important than others? Like this next chart you have is workers that change jobs or experience faster wage growth. And so as we dig into this kind of worker data, what do you put, heavy emphasis on versus maybe some of the data points that you ignore?
Yeah, absolutely. So I think we do a really good job for our clients at 42 Macro of contextualizing all the things that matter within the context of all the various reports that we get out of the U.S. labor market. It's been a massive week for labor market data in particular. On Tuesday, we got the JOLTS report. On Tuesday, yesterday, we got the Consumer Confidence report. There are labor market surveys embedded in that. Today, we got the Employment Cost Index and the ADP employment report. Tomorrow, we get jobless claims. And then Friday, we get the actual jobs report. So in terms of focusing investors on kind of the general lay of the land, like what's actually happening in the labor market, and then we can drill down into the chart specifically. The labor market is cooling, but it is not crashing. And cooling but not crashing is actually supportive for risk. It's supporting of this elevated probability of a soft landing in the U.S. economy that is underpinning the current Goldilocks market regime. So let's get into this chart here, number two, where we say workers that change jobs experience faster wage growth. That's something that we observed in both the ADP median annual pay statistics. We also observed that in the Atlanta Fed wage growth tracker statistics as well. That's the blue line for the growth rate of wages for workers that change jobs relative to the red lines, which are the growth rate of wages for workers that stay at their jobs. So going back to that first chart where we show the private sector hires rate and the private sector's quits rate are now below trend and at trend respectively, having declined over the past several quarters, it's suggesting that we're going to continue to see slower wage growth, wage disinflation in the months ahead, which is obviously supportive of the rate cuts that are projected and priced into money markets.
Now, labor hoarding, I never even heard of that before. What is labor hoarding and what is that telling us?
Yeah, so the reason you've never heard of labor hoarding before, because it really hasn't happened throughout our careers. For the most part, we saw a little bit of labor hoarding in 2018 to 2019, but really it's been a post-pandemic excess monetary stimulus phenomenon that has really guided the U.S. economy and asset markets over the past few years. So what we mean by labor hoarding is labor demand just simply outstripping labor supply. So in this chart on slide 3 here, we show the total labor force in the top panel, which is still below trend relative to the 2009 to 2019 trend. We show gross domestic income on a nominal basis, which is well above trend and has been since 2021. And then the third panel, we show labor demand, which is household survey total employment plus JOLTS total job openings. That's the blue line at about 170 million. And then we show labor supply, which is again the total labor force, which is at about 167 million. The third panel, where we show our labor demand minus labor supply metric, that number is running at 2.76 million in terms of excess units of demand relative to units of supply of labor here in the U.S. economy. And that's obviously really important because it's obviously it's one of those contributing factors to elevated or slightly above trend sort of wage growth. And so the bottom panel there, we just we break out labor demand in terms of household survey employment, the blue line, and total job openings, the red line. And what we see is that the red line has been the only statistic responsible for generating the slack in the labor market that we've observed in the past couple of years. Recall that the spread between labor demand and labor supply peaked at right around just north of 5 million in the first quarter of 2022, and has obviously declined again towards 2.8 million currently. So all that slack that we've created in the labor market has really come at the expense of the red line in the bottom panel there, which is total job openings. We have not seen a broad-based decline in total employment, which is why we continue to call it labor hoarding. Companies are willing to take down job openings and slow the rate of wage growth, but they're not willing to fire people, which obviously would cause a recession. So in our opinion, we think this dynamic is persistent, is likely to persist because at worst, corporate executives are only anticipating a shallow recession. I would argue that, just based on consumer and business confidence metrics, that expectation of a shallow recession is actually moving in a positive manner towards expecting a soft landing and the sustainability of the business cycle.
Now, you say shallow recession. It feels like a lot of people just expect the recession to come. We can go through a whole bunch of data points as to why they're expecting that. But this other slide you have is saying that there's a number of indicators you guys are watching that shows a low probability of a recession. So it feels like the mainstream conversation is, of course, a recession's coming. How severe will it be? But maybe you're saying something else might happen.
Yeah, absolutely. So in our opinion, the probability of a soft landing remains the highest probability outcome in the U.S. economy. We are not in the soft landing camp. We're not in the no landing camp. We're not in the hard landing camp. We're in the camp that allows us and our clients at 42 Macro to make money. And we've been in the soft landing camp. We've been renting the soft landing camp since November 1st of last year in terms of anticipating and calling for a soft landing Goldilocks trade. So that obviously was spot on in terms of helping our clients profit from that view. In terms of this chart here, our Fab 5 recession signaling indicators, and these are hand-picked time series from dozens and dozens, if not hundreds, of time series that we analyze that ultimately give investors the best lead time with respect to reporting, and also the most consistency with respect to accuracy of predicting predicting a rising or falling probability of a developing recession here in the U.S. economy. So I mentioned we got the Conference Board Consumer Confidence Index yesterday. The labor survey differential within the context of that report ticked up by 8.4 points month over month in January, which is the fastest month over month delta we have seen in that time series since, I want to say, May of 2021. And so we're obviously moving in the wrong direction from the perspective of anyone who is positioning for a hard landing or is anticipating a hard landing outcome. And so in mass of these 5 data points, the only temporary employment in terms of the 3-month annualized rate of change there of minus 13.3%, only one of these 5 is signaling a high probability of a developing recession. 3 are signaling a low probability, and 1 is signaling a middling probability. So in balance, we don't think there's a tremendous amount of risk of a hard landing here in the U.S. economy, because the leading indicators that we have selected based on our careful research and understanding of these critical economic dynamics that suggest that recession is not really something that we need to be concerned about as investors.
Now, let's say that a recession is not something we need to be concerned about. Then obviously we probably should keep interest rates where they are. Do you think that we should be hiking them? I would actually argue that maybe we should be cutting interest rates, not a lot, maybe like 25 basis points with an eye to do like 50 to 75 basis points throughout the year as a way to kind of start easing back so we don't overshoot. But how are you thinking about, if you're, the Fed chairman and you got to make these interest rate decisions, given the data that you've got and the low probability of recession that you're seeing, do you just leave them where they are? This episode is brought to you by Bet Online. Do you like making a profit from sports betting? Well, set yourself up to take home the most profit possible using crypto to fund your sports betting, casino, and poker account at betonline.ag. You can avoid costly transaction fees, get your payouts lightning fast, and do it all securely and anonymously with the highest deposit and withdrawal limits in the industry. If you want to get in on the action, do it the smart way with crypto at betonline.ag. Head to the website, sign up with promo code POMP100 to get a 100% bonus on your crypto deposit today. If you go and you deposit, they'll give you 100% bonus if you use promo code POMP100. Bet Online. The game starts here. BetOnline.ag. Go check them out today.
Yeah, great minds think alike, my friend. The Fed in December acknowledged the market's pricing of rate cuts throughout 2024 and into over the next couple of years. And then, in my opinion, that's very warranted, given exactly what you said, which is they should be reversing course to avoid overshooting and over tightening the economy. Recall that the Fed thinks about its policy rate from the perspective of the real rate, not perspective of the nominal rate. And right now, we continue to see very obvious signs of inflation crashing lower. If you go back to Friday's PCE report for the month of December, we got core PCE in that report, both the 3-month annualized and 6-month annualized rates of change of core PCE, the Fed's preferred inflation gauge, are at or below 2%. And so, with at or below 2% is obviously well off the 3 to 4 to 5% rates of inflation that we observed in the last few years when the Fed was, anxiously tightening policy at the fastest pace in 40 years. So now that we are seeing pretty clear and obvious signs that inflation is likely to continue trending lower on a year-over-year basis over the medium term, it is a signal to us as investors, but also to the Fed as policymakers that they actually do need to tone down the nominal level of the policy rate just to maintain the same real rate as inflation continues to come lower. So in our view, it's good policy. It's piggybacking on the great policy that we continue to observe out of the Treasury. The Treasury got the QRA this week of the quarterly refunding announcement, and the coupon auction size is surprise to the downside. The net financing surprise to the downside. Bond issuance continues to be well subdued. If you look at their cash balance estimates for end of quarter Q1, end of quarter Q2, the TGA is above that, which implies right around $100 billion of fresh liquidity waiting to be pumped into the system. So there's a lot of really positive dynamics that are being pumped in asset markets from the perspective of monetary and fiscal policy here in the U.S. And guess what? It's for good reason. It's for all the reasons we identified going back to late October, early November of last year in terms of accelerated immaculate disinflation, evidence of a resilient U.S. economy persisting, but a cooling but not crashing labor market that is ultimately taking the winds, taking pressure out of wage growth, which obviously is supportive and a guiding feature for all these positive dynamics.
Now, when you see the Fed as one component, we also have the politicians on the other side, and they lost their minds. They're printing money. They're dropping fiscal stimulus from every corner that they got. Proxy wars, infrastructure bill, CHIPS Act, name all the other crazy things that they want to do. Should the Fed consider those inputs into the economy? And can they somehow predict what the politicians are going to do in that changing their monetary policy decisions? Like, it almost feels like in 2020, they were on the same page. Cut rates, print money. Now it feels like the Fed was like, let's tighten. And the politicians were like, screw you guys. This is too much fun. Let's just keep, pushing money into the economy. So how do you think about the relationship between the politicians and fiscal versus the central banks and the monetary policy?
Yeah, no, I think they're getting increasingly less correlated, to your point. If you think about what's happening with fiscal policy here in the U.S., we continue to observe a very positive fiscal impulse, albeit getting less positive at the margins. And less positive at the margins is a negative signal for the economy and ultimately for asset markets. I think we discussed that the last time I was on with respect to the change in our macro weather model signal for the stock market, for instance, going from bullish to neutral with respect to the rolling 3-month forward outlook. So that's something at the margins that we are observing. Like, if you look at the year-over-year nominal delta of the federal budget deficit, it's up about $320 billion year over year in the month of December. That's down from being up about $835 billion year over year in June. Right. So we are pumping a tremendous amount of money into the economy vis-a-vis the federal budget deficit. Then we are still pumping more money into the economy vis-a-vis the federal budget deficit on a year-over-year basis. It's just a lot smaller than it had been. But again, still positive. The fiscal impulse is still positive. It's just not as positive as it was. And we obviously have an election where it's an general election year. We're not going to I don't think anybody wants to hear you or me talk about pontificate about what's going to happen in the election. But the one thing I will say is we've done, obviously, as always, a tremendous amount of work in trying to help investors, clients understand and ultimately position and profit from some of these critical dynamics. One thing we note is that stock markets usually does really well in an election year, especially when a Democrat is an incumbent president on the ballot. Obviously, Joe Biden is not going to if Joe Biden is going to lose the race, it's not going to be because he didn't try in terms of spending, fiscal spending and pumping money and funds into the economy vis-a-vis the CHIPS Act, the Inflation Reduction Act. I think there's another act as well. But at the end of the day, you should be expecting these kinds of positive fiscal impulse dynamics. You should be expecting positive monetary policy dynamics just based on what's happening in the economy. So, just kind of summarizing all this, a lot of bears have just been wrong about, kind of right down the middle of the fairway stuff: monetary policy, fiscal policy, growth, inflation. You can't afford to get these things wrong as an investor. And in my opinion, I think the reason a lot of investors have gotten these things wrong over the past 2 to 3 years is because they're spending entirely too much time on Twitter. That's not an investment process. It just isn't.
Now we've got over the last 1 year, the S&P's up 20%. Year to date, it's up about 3%. NASDAQ had a monster year last year. What is your expectations given where the economy is, low probability of recession, Federal Reserve is going to do what it's going to do? Are you expecting this to be another monster year for kind of tech and Magnificent Seven, et cetera? Or do you think that this will kind of be a reversion back to maybe more of the historical type returns, in that like 6 to 10% for the stock market?
Yeah, probably the latter. There's a lot of, very positive tailwinds, supporting asset markets here, but the starting point of under positioned investors and, kind of reasonable valuations just don't exist like they existed at the beginning of last year. Now, that's not to say that we're bearish or there's any negative things that have really hit the tape yet. One of the things I think we do as, on a very institutional high end buy side level for our clients at 42 Macro that most sell side research providers don't do is, sort of a daily Bayesian grind through all the information and through all the models that really we need to be abreast of as investors to make, important critical pivots in our portfolio. And, we continue to refresh the same models every day, 6 days a week here at 42 Macro. We continue to analyze the same data sets every single month. Every time it's the JOLTS report comes out, the conference board report comes out, the unit labor cost comes out, productivity comes out. We analyze those exact same data points month after month after month after month, quarter after quarter after quarter after quarter, so that we can spot critical inflections in real time. And the reality is we have not seen any fundamental data point, critically inflect in a way that would be materially threatening to the current Goldilocks top-down market regime. Now, that doesn't mean it is not coming. It may come tomorrow in the form of a really negative outcome in terms of the Q4 productivity report or the unit labor cost data. It may come in the form of an adverse outcome in the form of Friday's January jobs report. We also have Meta earnings. I think we have Amazon earnings tonight. We got Apple earnings tomorrow on Friday. So there's a lot of information between now and kind of 4 p.m. Friday afternoon that suggests that what I just said about the positive fundamental developments changing at the margins, but until they change and or until our medium term quantitative risk management signals say that Goldilocks has a low probability of surviving, we're not going to change. We're going to continue to be bullish. So obviously you can check, our clients will check back with us tomorrow for those updates.
Where can we send people to find you on the internet or find out more about 42 Macro?
Well, only if they like making money. If they like making money, definitely come to 42macro.com. If you don't like making money, then God help you. I have, just follow me on Twitter. Darius Dell at 42 is my Twitter account.
I always appreciate it, man. I learned something, and I appreciate your balanced approach to whether we're going to have a recession or not. As you see more and more soft landing commentary come up, usually that is not a good sign.
Yeah.
But no, yeah, definitely.
Look, I know we want to wrap it up, but I do want to leave on this. I think you brought up a good point, right? If we look at our positioning model, one of the things we track a variety of different indicators in our positioning model, whether it be valuation, whether it be positioning, survey based or hard positioning in the CFTC report. We track investor allocations via the AI survey. So we're constantly monitoring positioning in the context of those long-term time series so that we could spot, sort of extreme values that would signal it's a good time to take the other side of a trade or calling for a pain trade. We call for the pain trade higher at the beginning of November in the context of the soft landing signals that we got from the economy. Right now, we are starting to get some elements of our positioning model that suggests now is a good time to be tactically reducing a market risk. That doesn't necessarily mean Goldilocks is about to end from a medium-term perspective, 3, 4, 5, 6 months, but it does suggest that, we could get a pullback here, a correction in stocks, in the order of 5 to 8%, which is very normal, very healthy. And I don't think anybody should, kind of lose any sleep over something like that.
I love it. All right. We'll definitely do it again in about 2 weeks. So let's hope that nothing crazy happens between now and then.
Absolutely. But hope is not an investment strategy. It's not a risk management process. 42 Macro is a risk management process.